Hello everybody. First of all, I'd like to thank all my subscribers, supporters, dear and near ones for their continuous support. In a short span of time, my channel has grown over 1,000 subscribers. Although it's not a very huge amount, but for me, yes, it's a milestone achieved. So I wanted to thank each and every one of you for your constant support and encouragement. If you are new to my channel, I would like to welcome you to my channel, The Commerce Specialist, where you'll find videos covering various academic qualifications and professional certifications, including life-changing business ideas and techniques. Ladies and gentlemen, today's discussion is based on leverage. This topic is very important for those who are at the higher management level and equally important for students who are doing their CA, ACCA, CMA, CPA. Even for those who are doing their BBA and MBA as well. Now, the very first question is, what is leverage? Guys, when we talk about leverage, we have two types of leverage: operating and financial leverage. When we talk about operating leverage, basically operating leverage is due to the presence of fixed cost in the total cost. So we all know by now there are fixed cost and variable cost. If there are a lot of fixed cost in the cost structure of a company would have high operating leverage. On the other hand, if you look at financial leverage is the presence of fixed interest, fixed finance charge. If a company has fixed finance charge, and obviously if a company has fixed finance charge, that means they have long-term loans. So if a company has long-term loans, that is debt in their capital structure, the company is said to be highly levered. Now, our discussion will focus on what is the importance of having leverage, whether it be operating or financial. How do we calculate them? What is their impact? How do we read? If we have, calculation is simple. If you have financial leverage of 5 times or operating leverage of 2 times, what does it mean? How can we use it in decision making? So what I'm going to do is I'm going to discuss them one by one with complete examples, numerical examples, to make your life easy. So let's jump into the discussion. So ladies and gentlemen, if you look at this part, here we are talking about operating leverage. As I already mentioned, operating leverage only exists if a company has fixed cost in its total cost. So I've just assumed some numbers here: selling price $50 per unit, variable cost $30, fixed cost $5,000, and number of units we are selling is 300 units. So we are looking at the current level, please. If the company is selling 300 units, what would be the total sales? 300 multiplied by 50, you get 15,000. Likewise, variable cost, if you look at for 300 units multiplied by 30, you get 9,000. You minus from sales your variable cost, you get contribution, an important term in marginal costing. From contribution, when you minus fixed cost, you get your EBIT. EBIT means earning before interest and taxes, also known as PBIT, profit before interest and taxes. So this is the base level, and I've assumed that what if the sales increase by, this is the base level, and I'm assuming what if the sales level increases by 16.6%. In other words, instead of selling 300 units, what if the company sells 350 units? What will happen? Sales, obviously number of units, 350 into 50, you get 17,500. Variable cost, 350 into 30, you get 10,500. From sales, you minus variable cost, you get your contribution. Fixed cost, as already assumed, 5,000. So your profit is 2,000. Likewise, I also assumed what if the sale falls by 16.67%, which means instead of selling 300 units, if you're selling 250 units, calculation as before. Just keep multiplying number of units with selling price, you get sales. Number of units with variable cost, you get variable cost. You minus sales minus variable, you get contribution. Minus fixed cost, you get EBIT. Now, how to calculate operating leverage? Ladies and gentlemen, the formula is here. Degree of operating leverage, or you can call it DOL. Percentage change in EBIT divided by percentage change in sales. So if you notice, this is your EBIT, This is your sales. When I say percentage change, the formula is very simple. You know, always new minus old divided by old. You get a percentage change. So when I'm talking about percentage change in EBIT, have a look at this. New is 2000, old is 1000 divided by old 1000. 2000 minus 1000 divided by 1000. So numerator, this all will give you percentage change in sales. So numerator, all this will give you percentage change in EBIT. Denominator says percentage change in sales. So if you look at sales, new sales is 17,500 minus old is 15 divided by 15. 17,500 minus 15 divided by 15. When you solve all this, you are getting 6 times degree of operating leverage. Now what is more important is, if we have a degree of operating leverage 6 times, what does this mean? This means for 1% increase in sales, if the sales increases by 1%, the EBIT will increase 6 times. So if I calculate, sales is increasing by, I don't have space here, I'm using it here. Say the change in sales is 16.67%. Increase in sales from 300 to 350. So the sales is increasing 16.67 and the degree of operating leverage is 6. You multiply 16.67 multiply by 6, that will give you 100%. Which means for every single percentage increase in sales, the EBIT will increase 6 times. So as in this case, if the sales is increasing 16%, the EBIT will increase 6 times. So 16 into 6 times is 100%. How to prove it? Have a look at this. From 1000, it has become 2000, 100% increase. So if the degree of operating leverage is 6 times, that means for every single percentage increase in sales, the EBIT will increase 6 times. And it is proved here. Sales is increasing 16.67, you multiply by 6, you get 100%, which is 100%. 2000 is 100% of 1000. Now many students ask me, should we use this formula? Yes, this formula is used when you are looking at comparative figures. Like for example, if I take this as year 2019 and I take this as 2020. So if you have comparative figure, this is the formula to be used. But if you have a single year, that is only this year 2019, then you should be using this formula. Degree of operating leverage is equal to contribution margin upon EBIT. So if you look at contribution margin, which is here, divide by EBIT is 1. So 6 divided by 1, 6,000 divided by 1 is 6 times. Answer will be the same. So what you need to remember for operating leverage, number 1, operating leverage exists if there is fixed cost. Now what happens if a company has fixed cost? They need a minimum contribution to cover fixed cost over and above the profit. So higher the fixed cost, higher the operating leverage. But it works both ways. Look, if we talk about case A, sales is increasing by 16.6%. Operating leverage being 6 times. So 16.6 into 6 times will give you the change in EBIT, which is 100%. But what if the sales decreases? See, arrow down. From 300 units, if it goes down by 16.67%. If the sale decreases, what happens to EBIT? Opposite effect. EBIT will reduce 6 times. So, you know, it was 1000. Now it's 0. So 16.67, if you multiply by 6, that will give you 100%. So if it is going down from 1000, the decrease will be 100%. It becomes 0. So, ladies and gentlemen, please note the answer for degree of operating leverage shows if there is a certain percentage change in sales, by what percent, by how many times EBIT will change. So it's both ways. A slight change in sales will bring 6 times change in the EBIT. If sales is increasing, EBIT will increase 6 times. If sales is decreasing, EBIT will decrease 6 times. The operating leverage is 6. So if sales is increasing by 6%, you multiply by 6, 36% EBIT will increase. And you know, companies, you know, they announce interim dividends. How do we announce interim dividends when the year is not over? We are looking at projections, we are looking at forecasts. So if there is a forecasted increase in sales, which is quite realistic and dependable, so yes, if we know that the sales is increasing by 10% and the operating leverage is 6 times, 6 into 10 is 60%, EBIT will increase 60%. Yes, we can announce dividend, interim dividends. So guys, another thing you need to look at the core basics. If the company has higher fixed costs, that means the company is highly automated. If the company is highly automated, that means the company has no variable cost. If the company has low variable cost, then the company is bound to have high operating leverage and vice versa. So ladies and gentlemen, I hope you have understood operating leverage. Now I am taking you to financial leverage. Financial leverage is basically a measure of solvency of a company. When I talk about financial leverage, I'm talking about the presence of debt in the capital structure. Capital structure is like total assets equal to total liabilities plus total shareholders' equity. So if there is more of liability, more of debt in the capital structure, that means the company is highly levered. There is high financial leverage. And financial leverage is basically because of the presence of fixed interest, or you call it finance charges, finance cost. So ladies and gentlemen, in this example, I've assumed something. I've assumed the company has 5% bonds, which is 40,000. Obviously, the amount of bonds, the long-term debt is 40,000. 5% on that would be the interest on bonds. Okay. I've also assumed that the company has 10% preference shares, which is 20,000. EBIT, I'm assuming at the moment 10,000. Tax rate of 35%, and number of ordinary shares outstanding is 1,000. Now looking at these assumptions, again the base year you can take it as 2019 for example, and this be 2020 and this is 2021. So we are looking at the base year. If the EBIT is 10,000, assuming from EBIT, obviously EBIT means earning before interest and taxes. So if you have an EBIT of 10,000, okay, and your interest is 5% on 40,000. So 5% of 40,000 makes 2. So 10 minus 2 will give you earning before tax, or you can also call it profit before tax, which is 8,000. Then you minus tax, which is at the rate of 35%. 35% of 8,000 is 2,800. You minus, you get profit after tax, which is 5,200. From profit after tax, you can call it EAT, earning after tax, or profit after tax. It's up to you. From that, you minus your preferred dividend, which is 10% of 20,000, which is 2. Now you're left with IAC. You can call it income available for common shareholders, ordinary shareholders, or simply income available for distribution of dividends to ordinary shareholders. So how much is that? 3,200. This 3,200 I have divided by 1,000 ordinary shares. That gives me an EPS of 3.2. Similarly, for 2020 and 2018, this is 2020, this is 2019 and 18. I am assuming, what if the EBIT increases by 40%? And what if the EBIT reduces by 40%? What happens? First of all, we need to know how to calculate financial leverage. The formula is here, ladies and gentlemen. Degree of financial leverage is equal to percentage change in net income divided by percentage change in EBIT. Again, most of the students, they have a query which formula to use. If you have comparative year like 2019 to 2020, if you have two different years given, last year and this year, you should be using this formula. Percentage change is net income divided by percentage change in EBIT. So if you look at the percentage change in net income, this is the net income, new net income. So this is new, this is old. So 7,800 minus 5,200 divided by 5,200. This gives you the numerator. Percentage change in EBIT, it is 14. 14 minus 10 divided by 10. So when you solve all this, what do you get? Your degree of financial leverage is coming to 1.25 times. What does this mean? This means if your EBIT is increasing by 40%, see from 10 to 14, it's a 40% increase. If your EBIT increases by 40%, this 40%, I'm doing it here, 40 you multiply by the degree of financial leverage, which is 1.25. So that gives you 50. So if your EBIT increases by 40%, your EBT or profit before tax will increase by 50%. If you see from 8,000, if you add 50% of it, it becomes 12. So that is what is important here in financial leverage. The answer of financial leverage 1.25 times tells you if your EBIT increases by a certain percentage, 10, 15, 20, 40, whatever is the increase in EBIT, you multiply by the degree of financial leverage, that tells you the increase in EBT. But here again, you have another formula. This formula is used, that is EBIT upon EBT. It is only used when you have a single year. You don't have comparative years. Like here, you have 2019 to 2020. You have 2 years. If you have 2 years, you can use this percentage change formula. If you have a single year, only this year, base year, 2019, simple EBIT divided by EBT. And this also gives you the same answer, by the way, 1.25. And what does 1.25 says? That means for a particular change in EBIT, let's say 10%. If EBIT is increasing or decreasing by 10%, what will be the change in EBT? 1.25 times of the change in EBIT. So let's suppose if the EBIT, that is earning before interest and taxes, if it increases by 100%, what will be the effect on EBT, that is earning before tax? If your EBIT is changing by 100%, you just multiply it by degree of financial leverage, that will give you 125% change in EBT. I hope you have understood this point. So this change can also be measured in terms of EPS. That's why I calculated EPS. In certain qualification, not in CMA. CMA, they calculate it this way or this way. But in certain qualification, other qualifications, they also measure it as a percentage change in EPS. So the formula I've written here, this can also be calculated as percentage change in EPS upon percentage change in EBIT. So if you calculate the percentage change in EPS, see this is the new EPS, this is the old, new minus old divided by old, divide by percentage change in EBIT, you have percentage change in EBIT, new minus old divided by old. When you solve all this, you get 2 times. What does this mean? If you calculate it through EPS, that is percentage change in EPS divided by percentage change in EBIT, if it comes 2 times, what does this mean? That means if the EBIT changes by 40%, see from 10 to 14, so EPS will change 2 times, or 40 into 2 will give you around 80% approximately. So if you look at EBIT is changing by 40%, increasing by 40%, your EPS is increasing by almost twice. And if EBIT reduces by 40%, your EPS will reduce by 80. How? Because it is reducing by 40, 40 multiplied by 2 will give you around 80%. So this is, ladies and gentlemen, degree of financial leverage. In a nutshell, degree of operating leverage measures the use of fixed costs to generate income. Here we are talking about the use of finance costs, which is interest expense, debt, to generate profits. Both magnifies the company's efficiency. If it is appropriately used, sometime fixed interest cost is a blessing. And the blessing when your EBIT increases. A slight increase in EBIT will give you this much increase in profit before tax. When we talk about operating leverage, a slight increase in sales will give you this much increase or decrease in your EBIT. In the end, ladies and gentlemen, especially for CMA courses, CMA Part 2, we also have financial leverage ratio, or you call it equity multiplier. What is equity multiplier? Have a look at the formula. total assets divided by total shareholders equity. So I've assumed here total assets to be 100 million, total liability 80 million, shareholders equity is 20 million. So the formula is total assets divided by total shareholders equity. So total assets is 100 million and total shareholders equity is 20. So that gives me an equity multiplier of 5. This 5 shows what? This 5 shows your financial leverage ratio is high because there is more debt. Why there is more debt? Look at the debt, 80%, equity is just 20. Have a look at this. Here I am talking about total assets 100 million and I am taking the shareholders equity as 80. So it will come from 1.25. 1.25 means if shareholders equity is 80, that means debt is low. So low equity multiplier would simply means that the company is safe. If you have, for example, shareholders equity is 20, then obviously this will come to 5. A high equity multiplier means that the company is using more loans. Why? Because the debt is shareholders equity is 20. That means the 80% is debt. Ladies and gentlemen, I hope you have understood this topic well. If you still have any queries, please put down your queries in the comment section. I will definitely respond as usual. Ladies and gentlemen, once again, I would like to thank everybody from the bottom of my heart for all the continuous support and encouragement. If you like this video, please share it with your friend and family members so that others can also benefit. Thank you so very much for your precious time.